percent revenue and EBIT CAGR for Coforge. So that's the reason why a big initiating report on Coforge with a target price of 23.46 or potential more than 50% upside.
Okay, well, this is one of those. This is not a tinkering call, right, Nimish? This is a directional call. Okay, more later. Stocks up 2% in the pre-open, and we'll have more coming up. What do we have? First, couple of seconds to, just a couple of seconds to go for market open. So we'll look at rates, and then we'll get down to individual names. So the opening bell goes off about 0.25% higher, 24,680. You've got the Nifty Bank, which is up about 0.4%, 54,660. And you've got, what else? Mid-cap index up about 1/3%. The small-cap index will come up with some gains as well. So out of the gates, right of the word go, about 2:1, advances to decline, although I suspect that will change as we go along. But it's not a bad start. Back above 24,700. I mean, actually something similar to what we saw yesterday. It's just yesterday, of course, markets were not able to hold on, and there were multiple waves of selling which hit some recoveries as well, but finally we ended unchanged. That's the Nifty heat map, overwhelmingly positive. There are some stocks down in the red as well. I mean, the setup still, of course, remains the fact that at least large cap indices remain extremely oversold. So that backdrop is there, but we'll have to just see how much is in the tank for the market to even see some sustainable lift, even if we are able to remain, even if we are to remain in the range, broad range for the Nifty out there. So 24,700 to begin the session. Surabhi.
Okay, let's look at the gainers. Titans had a good showing so far this week. It's only day 2, but it's looking good. 2% up. Nifty winner. Then there's Power Grid. There's Hero Moto as it makes its way out of the index. It's having a good session, at least. Good morning. 1.5% up on that one. Asian Paints, BEL, which announced some order wins. These are all your gainers. Steel stocks are looking good. Hindalco, JSW Steel. Let's check Tata Steel if it is part of this. Tata Steel also up about 0.5%. So metals are in form. Tata Consumer as well on the upside. Kotak Mahindra Bank, the stock that Nimesh was just talking about, that standout brokerage report, it's up about 0.5% at this point in time. Not too many stocks on the downside, actually. Tata Motors down about 0.5%. There's ITC and Tech Mahindra, but that's about it. I mean, the market seems to be finally in a bit of a festive morning mood, at least. Let's see if it lasts. 70 points up on the Nifty. Nigel.
Well, Man Industries, that's the stock that's getting hammered on the downside. The regulator has pulled up some of the, people some of the promoter entity and the like. So that's why, in fact, that's one stock that's getting absolutely smashed in today's trading session, down close to around, I think, 15% as we speak. The company, though, they've come out with the clarification that they're cooperating with the regulator and they're looking for a better outcome. They're maintaining that they have a good, a good order book as well. For the time being, the street is not buying into that. At the low point of the day, volumes massive. So we mentioned about Titan. Kalyan Jewellers, that's popped up in trade as well. Good uptake is what we're seeing on that particular name. The other big winner is DCX Systems. Just pull up that stock. Yesterday it ended at the low of the day. By the end of the trading session, we got to know that Motilal Oswal was the one that sold. But they won an order. It's only 50 crores odd, but a strategic one because it's coming from an Israel company. So I guess that's why the street likes it. That stock up and about in today's trading session. Another one is Cybertech. We don't talk about it very often, but they've declared a dividend of 20 rupees or thereabouts. So I think that was one of the top gainers, Cybertech System. That stock up and about in today's trading session. Saman Capital in the F&O ban. Big fund buying yesterday. And they could be looking at raising some capital as well. Continues its good form. Friday, late in trade, we had told you that it's possibly coming out of the F&O ban. That's what happened. Now it's back in the ban. But massive action is what we saw on Monday. All those that wanted to get in have got in. And Vascon, stock opened 2% up, corrected, but that dip has got bought into, still holding with a gain of around 1.5%.
Without making it's not a comment on Samman per se, but I mean, just the broad category of the theme which is playing out in Samman, right? When there's, as they say, when stuff goes from bad to good, as I said, it's not a comment on Samman. I mean, there's a big, sometimes there is big re-rating which happens. Lots of issues. I mean, the erstwhile Samman. This was Indiabulls Housing, if you remember. But, I mean, there is, attempts afoot to turn this. And I think, ICICI Pru coming in, etc., perhaps a case in point that they're trying to attract institutional participation. I don't think there were any institutions before ICICI picked up some 42 lakh shares yesterday. So 4% on this one, 160 or so. Devina Mehra is with us, founder, chairperson and managing director at First Global. Devina, good morning. Great to have you with us here. Thanks very much for joining us. We're still stuck in the range without really a line of sight, either up or down. And no real triggers as well in that sense, right, Devina? What are your thoughts to kind of sort of kick this conversation open?
Good morning. So, yeah, I mean, because the news also has been there on both sides. So tariffs in India have been positive, which is the GST, and tariffs which President Trump has brought in has been negative. So, I mean, markets will always frustrate you one way or the other. That's the nature of markets, that they will never do what you expect them to do. And when you get frustrated is when they will suddenly do something you didn't expect. So actually, sentiment is a contra-indicator. So that's what all research studies across the world say. So if I go back to July, August last year, the mood was euphoric. I mean, people would come and tell me that I don't have, and this I'm talking family offices, saying I don't have unrealistic expectations, but I'll be happy with the 30% compound. I said that is an unrealistic expectation. So when the mood is so buoyant, and this is what studies show, the next period returns are below normal. And when everybody is anxious, asking, should I stop my SIPs? Should I get out of the market? The next period returns are above normal. And I don't see it. That I don't know when the market will move up or that it will. I'm not saying that it won't move down at all. But if you look at what you should be doing, I don't see an imminent crash. And most of the time, it helps to remain invested to the extent of your equity allocation. And again, I'm probably repeating myself, but don't have 100% in equity, even if you are young, even if you're in a good job. But whatever is your equity allocation, remain invested. This is not something you asked, Prashant, but I caught the tail end of what you were saying earlier. So not commenting on a stock, but one of the very interesting things, very large global fund manager told me, he was one of the people who coined the terms emerging markets. So he's like that much of a stalwart. And he said that, and which I found in my life also, in my experience also, that the big money is always made when a company goes from bad to average, not from when it goes from good to very good. So that's actually true.
From one end to the other, but yeah, from just turn, right?
Bad to average. So
Bad.
I said bad to good. You said bad to, yeah, I mean, not great.
So
we both agree, not great.
Bad to good, you are better off than somebody going from good to great. So, and this is, even in cyclical industries, I have found this so often that when the turnaround in whatever the commodity price or whatever the reason for the cyclicality comes, it is the worst stocks in that business that do the best, because the cash comes in, they can pay off their loans, and there's a reflexivity. The stock price goes up, they can raise more money if required, and suddenly, if you have a 1% a net margin, if the EBITDA goes up by 2% points, it is a tripling of the net margin, whereas the guy who was already at 10. It is only from 10 to 12%, so the percentage is not so high. So it's a very interesting phenomena, which is why I always say that, do the actual maths. Don't do upar ka ki that this will happen to margins and that will happen to profit. Do the whole exercise as to what happens to cash flows, what happens to balance sheet if this happens. And you'll see a very different scenario emerging.
Very, very interesting. That gentleman I'm guessing you're referring to would be Mr. Jim O'Neill, the father of the BRICS acronym? No, someone else. Okay. All right. Devina is not taking names. Devina, but just to go back to the earlier point that you're making, you've always made that point. Don't keep all your eggs in one basket. And this year, if any, has been such a stark reminder of that cardinal principle of investing, right? I want to get your thoughts first on gold, then we'll talk about the US market as well, where you've always, advocated a very sensible allocation. On gold, though, because it's making a lot of investors feel silly, just to see something go up 40% in 1 year. So are we at a point of excessive optimism now? There are people who are feeling major FOMO, thinking, should I now at least have a silver ETF, gold ETF? What would you say?
I would say be very careful. I saw a headline somewhere saying that gold has not seen this kind of rally since 1979. That's the last time it saw this kind of rally. So I said, let's go forward from 1979 and see what happens. And gold made a high in dollar terms in 1980. And thereafter, if I go from 1980 to 1999, 19 years, imagine what the return on that investment in gold was.
So that doesn't answer my question. Buy or not buy now? Those who bought are super happy. They're waiting for a bumper Diwali. The ones who didn't allocate enough are wondering, what did I do this year?
I'm just coming to that. So it came down 62% from that high. So the 1980 price of gold was not crossed till 2007. For 27 years, it was underwater. Going down 62%, as I said, in the interim. The next high, it came down 40%. So if you look at the dollar chart of gold, it has been more volatile than equities. Gold has been more volatile than the S&P 500. So it's no safe haven. In rupees, the chart looks good. So even the time that the dollar price went down 60% over 19 years, it tripled in rupee terms because rupee has been depreciating. So at that time, the gold was the only way to get kind of overseas exposure, but now you're not stuck to gold. So now it is in frothy territory. I'm not saying it may or may not go up, but this is the time when you get FOMO is when you enter at the wrong time, because usually that asset has had a huge run up. Everybody on the street knows about it. And then when you get it is dangerous. So have some gold in your asset allocation, but it should not be 25, 30%. And yes, we have added silver also, because silver is looking good compared to gold. And silver also has industrial usage. And with the renewables, that is one area where silver is used. So actually, in terms of industrial demand, also silver has been going up. Coming to the other part of your question, which was on global allocation. So suddenly, because the Indian market has not been doing very well, people have started thinking global. But number one, you said I asked people to go for US allocation. No, I don't. I always say global. US is not the world. That's the number one thing to remember. US has been outperforming for a very long time. Doesn't mean it will always outperform. Since January in our global funds, in fact, we've been underweight US. We've been overweight Europe. So till June, July, of course, Europe had huge outperformance. Now US has done a bit better in the last couple of months. And we've been overweight China since last year. So you have to make these tactical reallocations. Unfortunately, because now suddenly India has not been doing well, people are talking global. A lot of people with no global expertise whatsoever are positioning themselves as global experts. So be aware of that.
Hi, Devina. Good to see you. When the point on gold, there are a few periods that I went back, 45 years or thereabouts in terms of data. 1980 to 1986, gold didn't move much. 1992 to 2002, I think it didn't move that much, in terms of, I think, percentage terms, it was some double digits across all those years. And 2012 to 2019, that's the time when it didn't move too much. But in the last 1 year, that's been the asset to go forward. That said, Devina, let's talk about equities. Give us a couple of stocks with all due disclosures that y'all are very, very bullish at this juncture. Couple of stocks, if you could name it, please.
So let me tell you this, that recently one of the bigger banks asked us that, which are your high conviction bets? And I sent them a 3-page note on why, in principle, we do not have high conviction bets. Because what is a high conviction bet? That you bought into a story, you're married to a stock. That's the last thing we want to do. So we have a very diversified portfolio in our PMS. In fact, even in our small case, we typically have 25, 30 stocks. And so it's across industries. So it is really, I'm not making a big bet on a single stock ever. That's not something I do. So where we are overweight has been since last year. So now almost, 1.5 years plus has been pharma, healthcare, auto components. We've added a couple of auto companies in the last rebalance. What has increased and become overweight in 2025 has been FMCG. After that, of course, there have been individual stock picks, something in chemicals, etc. Banks, we are not overweight, but we are holding more than what we typically hold because banking as a sector, after many, many years of underperformance, is doing better this year. So that would be the broad strokes. But I mean, our PMS is called India Super 50 because we hold 50, 55 stocks. so it's not like a 1 or 2 stock bet. And no one knows the future. So never tell yourself that I know the long-term future of this company, whether it is HDFC Bank or Amazon or Titan, or even the management could not have told you the 20, 30-year trajectory.
What are the newest things you've done in this portfolio, Devina, if I were to put it like that?
So this year, more FMCG companies have been coming up. So as I said, this year we have become overweight in FMCG. We've added a couple more of the auto stocks. We already held auto. So that is, and as I said, we've also added to banking this year. Now, of course, now that the quarter is ending, now we will be looking at everything once from base zero. So we forget about what we hold and we look at if we had cash today, where would we invest? Of course, typically from one quarter to the other, 85-90% of the list is the same. But as a discipline, it is very important to tell yourself that because there's something called endowment bias where you overvalue what you hold. So I say the hold rating exists only because of endowment bias, because if you see objectively anything you won't buy today, you should not be holding.
Right, yeah, absolutely. Devina, since you have a global perspective, you've looked at other markets and what's happened, bigger trends, etc., right? You got to, obviously you do apply some of that to, what happens sometimes, not always, but you got to use that knowledge in the Indian context as well. A lot of trends are global in that sense, right?
Right.
And in a variety of businesses, and there are companies, for example, in logistics where stuff which has happened globally, and these are newer businesses, relatively newer listings in that sense. Of course, in compute and AI, etc., we don't have very much, but we have a couple which, of course, now are trading at 50 times forward earnings, etc. So valuations perhaps are a bit of an issue. What else? I mean, you got a few construction, for example, prefab stuff. I mean, do you kind of sort of actively look at some of this stuff? Because, there's the old economy, banking and consumer and FMCG. I mean, that'll continue and it's got to be a part of the portfolio. But these are more niche businesses where you've got to be careful, but makes sense to look at them, doesn't it?
See, anything new is high risk. So if you look at new technologies, I read the farewell column of a technology columnist after 40 years of writing that column. And he said, I can just go back and say so many technologies were launched with great fanfare, which went nowhere. So 3D televisions, Google Glass, Apple Car, and I can go on. So one is that which technology will succeed? How long will it take to succeed? We think, electric vehicles is something new. Reva car was launched, I think, 23 or 24 years ago in India, I'm talking about. I'm not even talking globally. So which technology will succeed? If it succeeds, which company will succeed? Will it make enough return on capital? That's the other part. So if I go back to the internet boom, there was this thing that whoever wins, we'll need the internet's infrastructure. We'll need things going across continents. So there was this company called Global Crossing.
Yes.
Which laid on
the famous case.
Yes,
Absolutely. That's a very famous case. My question is not that, Devina. My question is proven stuff outside, which is happening here now. This is not stuff which is...
AI, what is proven stuff?
Not AI. I'm not talking about AI. AI just gave an example. I'm talking about... something. I'm not naming names because you don't want to name names and you don't want. You can't.
Recently, there was this study on where these AI models were being used, and during the summer vacation, 70% of the usage went down.
I know that.
So something you might invest in, and now to be in the game, you have to invest. You have to invest in the data centers. You have to invest in the AI. You are hiring people, individual people at $100 million, $200 million, $500 million. But will the market pay the return? So global profit example was only that infrastructure was required, but you will not get a return on capital on that. So that's the part which is hard. And a technology that succeeds can still be a graveyard for investors. Automobiles and aviation from the 20th century are like poster child for that they changed the way the human beings live, but they didn't make returns for the investors. So be very careful. I mean, the story is very interesting at any point in time. Again, data centers. What is data center? When you set up a data center, what is it? It's a lot of real estate, a lot of equipment which depreciates very quickly, a lot of power and energy. So that is
absolutely.
It's a
Sometimes I feel, Prashant, David, I was listening into her as well. Sometimes I feel maybe on a lighter note, it's easier to sell more complex stories, right? If you're selling, if you have to convince investors about a toothpaste business, 100 questions are going to be asked, right? But it's data centers, it's some voodoo.
दिन में कितने बार brush करते हो?
But it's new age tech, which has not been proven. Maybe it's easier to sell in the hype era. We are in the hype era. How it ends, we will all find out. I think in a couple of years.
I think absolutely what Devina is saying, absolutely completely cautionary advice, absolutely good stuff. And maybe this is not the platform, Devina, but maybe we can invite you back on maybe some other program and we can go into some of this detail, right? Because this is interesting stuff. It doesn't apply to here and now, this stock or that stock, but I think how you think about some of these things, I think it's important to debate and discuss. Thank you very much, Devina, for joining us.
Thank you.
Great speaking with you. Really appreciate your time here on CNBC-TV18. I think we'll just look at that, right? Markets were up 70, they're up about 30 now. So like yesterday, this is just the start, not being able to hold on. 24,660 is where we are at. I just want to quickly highlight one or two names. There's Blue Dart and there's All Cargo, All Cargo Gati, which is in focus. Mangalam is here to tell us why. Mangalam, over to you.
Well, both these stocks are buzzing in today's trading session, and there are a couple of reasons for the same. The first one, obviously, is Blue Dart has, as an annual exercise, announced their price hike as well, which is usually to the tune of 9 to 12%, so no different from what the company typically does, at the end of September every year. So that's something that the street has been anticipating. And All Cargo Gati has also gone ahead and done that. But the good part is because of the GST cuts and the boost on consumption, etc., and the early indications that we have from, Amazon's sales and Flipkart Big Billion Days sales, that e-commerce activity is picking up, especially ahead of the festive season. So all these factors working for these solutions providers for e-commerce logistics in this quarter. But come January, you will have an effective price increase between 9 to 12%. The company usually gives their clients a quarter to go ahead and, intimate them that there is a 9 to 10% price increase so that there leaves some room for negotiation. The important part is what the stocks do between these two announcements. Because if you look at it, over the last 12 months or so, Blue Dart from the highs has seen a correction. All Cargo Gati too hasn't seen a big rise in the stock price. So the price move has come on account of the price hike that the company has announced, but delivery, literally and figuratively, on those price announcements and their impact on the revenues is something that the street will be tracking over a longer course of time.
Okay, all right, Mangalam. Thanks a lot for that. Well, let's move on then and let's invite our next management. Premier Energies has signed a near $20 million solar power contract in West Africa. We have with us Mr. Vinay Rustagi, the Chief Business Officer at Premier Energies, who joins us on the show. Hi, Vinay. Good morning. Thanks a lot for joining in. Coming across to you. For the time being, just highlighting the three broad points that we're going to be looking at, the rationale behind the West Africa foray. And is it a one-time or are there more such forays planned? Point number two, the impact of the lower GST on renewable sector. And finally, the outlook of Indian module prices amidst the rising capacity. Well, Vinay, good to have you on the show, sir. I recall earlier you had said that your focus is going to be more domestic in nature and you don't have much capacity for exports. So tell us more about this African foray. What kind of capex will be required from your end? Is this the one-off or do you have more plans to get into the global arena?
Well, thanks for having me. And you're right, we did say that for us, the focus in the short run is the Indian market. Having said that, we have to bear in mind that today India is one of the largest and the most competitive manufacturer of solar panels in the world after China. The domestic manufacturing ecosystem is growing very strongly, partly because thanks to the government's support for Make in India. And as we grow our capacities and capabilities, it is imperative for us to look for new growth opportunities. And hence, you will see us tapping into markets in Africa and other countries around the world to find new opportunities for us.
But could you tell us, in terms of the investment, initially you mentioned around $20 million. What kind of an asset turn will you be looking at in terms of these markets? How big can the pie get? Some broad outlook in terms of the total quantum you're looking to spend and how much you're looking to penetrate into that market.
See, in terms of the outlook, the money that we're going to spend on this, it is going to come out of our existing operational capacity. So there is no capex involved. The $20 million number that you referred to is the order value. And this order value comprises installation of some rooftop solar systems, solar heaters, as well as solar street lights. It'll all come out of our existing production lines in India. And there is no new net incremental capex involved for us.
Yes.
In terms of the market size, like I said, solar is booming around the world. Africa is a great opportunity, particularly as the country has very low penetration of power. And off-grid and new distributed solar systems are going to be instrumental in electrifying most of the continent. So hence, we are looking at that opportunity out of India. But in terms of new capex, there is nothing as yet.
I just did a quick search through in terms of competition in Africa, and that's what I really want to understand. So Vinay, there are players like Scatec, EDF Renewables, First Solar, which is US, EDF is French for the benefit of our viewers. The Italians are there, ENEL, Green Power, etc. So the who's already reached Africa, right? In terms of just trying to gain some market share, give us a roadmap. Say over the next 3 years, how much of your business will continue to come in from India? How much will you target Africa? And will you at all look at the US? Though the US has enough issues of its own in terms of tariffs, very high regulation. But I don't know, since you're looking global, will you look towards the US at all?
So I think there are many issues that you covered in your questions. So let me try to address them. So when you talk about players like Scatec and other European players and maybe people from China coming into Africa, that's absolutely right. But the sector has a very distinct, I would say, three-part value chain. One is the project developers. These are large companies who are setting up mainly ground-mounted projects, and that is where Scatec and some of the other big majors from around the world are focusing on. Second part is the EPC, which is people are just buying the equipment and installing these systems. And the third part is the equipment supply. Equipment supply is where there is a massive shortage in Africa. And most of the equipment is imported from other countries, including China and India. And that is the market that we are really focusing on. So as far as we see, there is not too much competition other than, I would say, China. And hence, we are kind of really trying to see with the government support if we can find a good, attractive market, which does open up a new growth opportunity for us. So I think that is the outlook in comparison to Africa and how we are focusing on that market. There was an earlier question about GST. So I think in terms of GST, I think it is a very good move for the entire sector.
Vinay, just 1 second. Sorry, to complete the Africa point.
Sure.
So when you have to compete with the Chinese in that international market, typically when you compete with the Chinese on anything, the competition comes down to lowest cost pricing. So is that an arena that you can compete in effectively at all and yet retain profitability and decent margins? I mean, what will be the margin of your Africa business vis-a-vis your India business? Again, I'm not talking about immediate. I'm talking about a 2-year roadmap or 3-year roadmap.
So I think in terms of the competition, you're right. The direct competition is with China. But then, there are ways to open up that market, particularly with the government support. The government has various tools in terms of trade treaties, developmental aid, and Exim Bank financing, etc., which can open up a very attractive opportunity for India. And that is what we are mainly looking at. So Africa does need a lot of developmental aid. The Indian government has a very good relationship with many of the countries across Africa. So we are hoping that with the government's help, we can open up this market. And in terms of pricing and margins, so the overall pricing and margins for us are largely in line with the current business in India and overall very attractive, meeting our threshold returns. Your other question was about what is the 3-year outlook for us. So I think it's very difficult to say right now. We are looking at the US market as well, but obviously there is a short-term uncertainty because of the 50% tariffs. Plus, there is a new anti-dumping duty petition which has been filed in the US against imports from India. So I think there is a short-term uncertainty. But again, as you would know, the Indian government is trying to sign a free trade agreement with the US, and there are expectations that some of these tariff levels will be reduced, ultimately again opening up the US market as well. So the long-term outlook for the Indian exports, I would say, is attractive because as we are growing capacities, the cost of production is coming down, and solar demand is growing everywhere in the world.
Vinay, can I come in? Morning. Sure. Did you watch President Trump's speech at the UN? Did you hear?
I did. Yes, I'm aware of that.
So, I mean, of course, that is. So he said, a completely full-throated attack, right, on the what he called the green energy agenda, dismissing wind, solar as costly, unreliable, return to fossil fuels, nuclear, calling carbon footprint a hoax, and warning other countries like Europe, etc., that their energy policies are a disaster. Now, there is, of course, a tariff bit in the US, but there is, of course, I think the bigger issue, tariff is just a manifestation of the underlying policy and the fact that they don't like all this stuff, right? At least for the next 3.5 years. 3.5 years later, we'll see whatever happens. But even with regards to Africa, Vinay, I'm assuming a lot of aid comes from US. I mean, US is the capital of the world, right? And a lot of aid flows through those channels. Even multilateral organizations. US has been the largest donor historically for EV. And these are all technologies where you need a lot of government support for adoption, and then they become self-sustaining. Isn't this a problem then?
So, let's take the US market. I think there is at the top level, there is some governmental resistance to renewables, but I think the overall picture for renewables, even in the US, remains very compelling. So if you look at the demand, there is a strong demand outlook because the end consumers, whether it is the IT companies, the industry, the retail consumer, the households, they still want solar solutions because this is the most competitive source of power. So we do expect the demand for solar to stay. Maybe there will be some small blips here and there. But overall, I think the market kind of is still growing in our view. And hence we are kind of looking at that market. When it comes to Africa, you're right. There are various competing players, whether it is the US, China, or India. I think India has to find its own path in the continent.
No, Vinay, my question is specific. Funding for projects. I mean, governments are there are developmental organizations fund a lot of this, right? Because countries there are poor, and they are. So isn't that is funding going to be an issue at all? Because the source of the largest amount of capital is the US, and there is a very specific targeted crackdown on many of this stuff now.
So, I'm not sure if US is the largest funder over there, but I think the Indian government also is very keen to work with the African nations to find an export market for Indian products. India is giving developmental aid to many of these countries, and the best example is our project in Benin, where the aid is coming from India in the form of cheaper financing for these products. So I think India is also the founder of India International Solar Alliance, which is a body which comprises over 40 nations from Africa. We are undertaking initiatives to reduce the cost of solar equipment for the African consumers. So I think India can still play an important role in the growth of solar power in the continent.
No, I wish you all the best of luck. I mean, we need more renewable power despite what President Trump says. And, that speech, certainly carbon footprint is a hoax. I mean, I don't know what to say to that, what to make of it. But anyway, it is what it is, at least for the next 3.5 years. And we've got to sort of navigate through some of this stuff. Thank you for joining us here, Vinay. I appreciate your time. Sorry, you were saying something, Vinay?
No, I said thanks for having me.
All right, thank you very much. We'll come back. Keystone Realtors on demand trends here in Bombay and outside on the other side. Stay with us.
Welcome back. So the market continues to drift along, 30 points up. Not too much of a major move either up or down. That's what we have for the time being. We're putting the spotlight on now the real estate space, and the company on our radar is Keystone Realtors, and we have Bowman Rustamirani, Chairman and Managing Director of the company, joining in. Bowman, always a pleasure to have you in. Thanks so much to talk about. So I just want to quickly lay it out for our viewers just to focus the conversation. Now, three key talking points. Number one, of course, we want to understand the impact of the GST cuts on cement and how that flows into the real estate sector. Of course, we need to understand some concerns, particularly in the super premium luxury segments. There is some chatter about a plateau, perhaps, in demand. So let's see what Bowman has to say on that. And then, of course, redevelopment, where Keystone is very, very active. We'll find out what the latest is, especially in Mumbai. So, Bowman, there you have it, the questions, or rather the themes laid out for you. Let's first start with GST. That's the good news, right, on cement coming down lower. How does it sort of improve things for you? Will some of it be passed on? I mean, I don't know, it won't have a material impact on the end price of a house. But just what does the cut mean for the industry and for the end buyer?
Well, thank you for having me on your show. And I must say that, this season, which comes along in Q2 and now continues in Q3, with regards to festivities in India, become a prime time for people to buy new stuff, whether it's cars, whether it's homes. And we are seeing this trend work out much stronger this year, given the fact that GST rate cuts almost came in at a time when, to improve the mood, the buying mood of the people. And we've seen the impact. On the 22nd itself, we saw the walk-ins increase. I must say the only thing that's played a dampener in the whole thing, and pun intended, was the rains. And weekends are generally when people are walking in to buy new homes, check out availability, etc. And we've had a washed out weekend last as well as the earlier one. So save and except that, I am very optimistic about the Diwali season, which is going to be in October this year, and we've observed that every year when Diwali comes in early, it actually makes for a bumper sale for homes as well. And our teams are gearing up more for the mid-mass and the aspiration category. Also, the premium category has seen a great amount of demand. I must tell you that the GST impact has led to a feel-good factor amongst people. The buying power or the belief that their buying power has improved and prices have been brought down are helping. On the real estate front, GST has been cut down on cement from 28 to 18. I can tell you most of the Mumbai developers, we use RMC concrete, and over there it was always 18%. So really no impact on that. And the other area where the impact will be seen is marble blocks and granite blocks. We'll have to wait for our suppliers because we buy them, in cut to size, etc. And over there's been no change in the GST. So we'll just have to wait as to what is passed on to us. What I can tell you is that the consumer durables or the air conditioners, the washing machines, all of these price reductions will definitely make the adornment of the homes a lot better and will impact our home buyers. So every home has, I would say, even if you have a 3-bedroom or a 2-bedroom, you'll have about 4 air conditioners, even 2 in a hall and then 1 each.
No, absolutely. And, even on ACs, the reduction is 10%. So it really, really helps when you're doing up a new house or even refurbishing your current house. But the other point, and it's interesting to note, you're sounding as optimistic as ever. And you're saying that even in the premium, at the premium end of the spectrum, there is as much excitement, because I saw some reports and some chatter, and I was speaking to some fund managers on the mutual fund side, and they were saying that they're picking up some hints of some sort of a plateau in excitement or, demand at the super luxury end. But you're saying that is not to be noticed, at least not in Mumbai, is it?
I'll tell you, it's exactly the opposite. And basically, Mumbai homes, if you take an average price, they're between the 17 and 30,000 rupee bracket, right? It's homes in prime locations, Bandra, maybe Juhu, maybe South Mumbai, certain areas of Worli. All of these is where you see prices going from 50,000 all the way up to 100,000 rupees and maybe even higher, which is what we keep seeing in the papers time and again. Actually, there has been a very strong upswing in demand for the luxury and uber luxury, and I'd like to define these as 7 crore to 15 crore and then above kind of homes. As a matter of fact, the demand has improved, has increased. And like I told you, our sales teams give us feedback that basically, if not for the rains, the last 2 weekends, you would have seen a bumper Q2, but now we are waiting for Q3 because all of this will spill over into Q3, and Diwali being a very auspicious time to make or buy a home is also going to assist this process. So, au contraire, you are not seeing any kind of a slowdown in the Uber.
You're saying it's the other, it's the other way, which is you're saying it's accelerating. That is interesting.
Yes, it's true, but I'll tell you, the overall unit sales have gone down to 97,000 versus 107,000. Mumbai and Pune account for still about 48% of the unit sales. And overall, while there's been...
What percentage, Baman, sorry, what percentage of your portfolio is in that, not the 7 crore price mark?
So now, again, a difficult question because we are having many launches come up this year. We kind of did project acquisitions or launches of about 4,000 crores in the first quarter itself. And we've seen a very strong surge in demand in homes that were launched in the Bandra area. So that gives me the confidence that this continues to be a growing segment. And we've also continued to do extremely well in our Mahim sales. There's 180 Bayview, Mahim Matunga sales have done extremely well. Our Versova launch, which is like, again, a premium segment because it's on the water, has seen a great amount of demand and buy.
Can I? It's an unfair question to ask you because you are developing these specific projects and they're doing very well. But broadly, and I've asked you this before, how much of this boom that we saw was related to the wealth effect from stocks going up over the last few years, and stocks now have been flat for the last 1 year. Broadly, they've been big wealth creators as well, but on a broad basis, as some of this runs off in terms of marquee projects, Matunga, for example, is the area which did not have very many high rises. They're coming up now. So it's like a cluster-specific thing. Bandra perhaps is another one. But in terms of direction of travel, Baman, will the pace slow down if just because of the fact that markets have not done well?
I don't have any data that points in that direction, quite honestly. As a matter of fact, all the feedback that comes to me from my team as well as other teams in and around Mumbai, even yesterday I was visiting a fellow developer's high-end development in Worli, and they were pleased as punch about the sales. As a matter of fact, they were telling me that the larger apartments, which would obviously make them a little more expensive, are the ones that are selling out faster, and they're even converting some of the smaller apartments, joining them together and making them larger apartments and selling. So really, I have no answer for you that points in the direction where you're stating about a slowdown.
Maybe it's all the stock sales. Maybe it's all the...
that is something you and I can both debate about. But I've said this before and I'll say it again. Not only am I seeing buyers from Mumbai buying, I'm also seeing especially these high net worth or high priced areas or the high value areas, I'm seeing buyers coming in from all across the country and buying in Mumbai. And if you open the papers on any given day, you've seen the kind of sales that have taken place, in the Andheri belt recently by a developer who came in from Delhi, and they've done phenomenally well, and they're looking at a lot more in this area. We're saying that we are seeing the same kind of results, and I think it's only a matter of a few days. This quarter will also announce itself, and all the listed players who are doing the larger developments will also have a similar story to say.
Okay, all right, Mr. Rani, we appreciate you joining in. You're sounding very gung-ho about demand going ahead as well. And thanks a lot for the suggestion with regard to the BSA 650. I tried the bike out. Quite impressed by it. Thanks a lot. Catch you soon. Thanks a lot, Mr. Rani.
Thank you, Nigel.
Have a good day ahead. Well, let's get back to markets. We have Vinay Rajani, the senior technical and derivative analyst who joins us on the show. Hi, Vinay. Good to have you back on the show. Tell us, what do you make of today's trading action? The good news is, at least it appears that the bulls are giving it a bit of a fight, and we're hoping to break that losing streak. How would you trade the index?
Yeah, good morning. So a more than 800 points fall in the Nifty. As far as today's trade is concerned, today I can see that breadth of the market has been quite strong since morning, and many stocks and sectors are performing like we are in a bull market. If we see the movement of PSU banks and some of the metal stocks, some of the PSU stocks, as well as some oil and gas sectors. So 3-4 sectors are showing the sign of bullishness. Breadth of the market is improving. Nifty seems a bit oversold, though we have not got any reversal sign on the charts of the Nifty. But there was a bank Nifty reversal pattern yesterday on the daily chart. That was the long leg doji candlestick pattern in the bank Nifty. And FMCG, which was not performing, now started recovering from the lower level. So it might happen that Nifty might take a pause in the overall downtrend, because Nifty has been falling for 7 consecutive sessions, and now many stocks and sectors have started performing. So I think there could be a consolidation in Nifty, but stock specific, I am bullish for the day. It might happen that PSU banks and metals can do well. So stock specific bullishness can be expected from the market, and I don't see any broad-based market selling in the from here right now. At least we can expect a pullback. As far as Nifty support is concerned, we believe that 24,600 to 24,500 is a very strong base. So that should not break immediately, at least. So we can expect some pullback or consolidation in the Nifty, but stock specific, yes, we are bullish for the day.
Okay, got it. What about stock specific action?
So as I said, our view on the PSU bank is bullish. So Bank of Baroda, which has actually shown a great amount of resilience in this current downfall of the market. So Bank of Baroda is looking strong on the charts around 259. One can go long. I would suggest a trading stop loss at 255. On the upside, I'm expecting a target of 267. The second pick I would pick from the metal space, Hindustan Zinc. So Hindustan Zinc is looking strong, and it has recently broken out from the consolidation and now trading above the key moving averages. So 475 is the rate around which one can go long. I would stop loss should be 467. And immediate target I can see on the chart is around 490. So Hindustan Zinc and Bank of Baroda with the mentioned stop losses.
Thanks a lot for joining us and giving us those quick calls, Vinay. Well, we have a few listings that just came up for you on the screen. I think we should get some of them up for you. I think let's get a few of them. Yeah, we have the debutant coming in from Anand Rathi Group, another stock that's listed. I think that had a mild positive gain out there. Solar World Energy, the solar EPC player, that in fact has a gain of closer around 1 to 2%. So a flattish start is what you're seeing. Sharesai Sai Tech, we'll have the management shortly with us in the next half hour or so. That one in fact has listed, I think, more or less flattish with a mild negative bias. But Anand Rathi share, that's up close to around 5%. And that's the big listing, the thumbs up listing of the morning, now up close to around 6%. Well, let's move on then. The RBI's MPC will announce its interest rate decision tomorrow. Ritu's with us to tell us the key expectations. Ritu?
From tariff tensions to GST cuts, a stronger than expected growth print, and even the potential fallout of H-1B visa restrictions on service exports, there's plenty that's weighing on the Monetary Policy Committee's mind as it gears up for its rate decision. According to a CNBC-TV18 poll, though, the RBI is expected to keep the repo rate unchanged at 5.5% in this policy, despite having the headroom to cut because of the lower inflation, and a very small majority is expecting a 25 basis point cut. Now, with the RBI having already front-loaded rate cuts, ensuring ample liquidity, the majority of the respondents we spoke to believe that the MPC may prefer to pause at this stage and assess the full impact of US tariffs and GST cuts before it takes any further action. On the terminal policy rate, 40% see it settling at 5.25%, another 30% at 5%, and the rest expected at the current levels. Now, the majority anticipates that the easing cycle is going to conclude as early as October itself. The stance of the policy, that is also unlikely to be tinkered with at this juncture. As for the macro forecast, 40% expect the growth forecast to be left unchanged, while the rest are expecting a 20 to 30 basis point upward revision, which will reflect the stronger than expected Q1 data. The inflation forecast is expected to be lowered, on the other hand, to about 2.5% to 2.7%, helped by lower food prices and, of course, the GST rate rationalization. Now, beyond the action itself, the language of the policy is going to be very important this time. A dovish tilt is what is expected, which could hint at future rate moves. Now, on the rupee specifically, economists don't really expect an explicit mention of levels, but the RBI is likely to stress that it will not tolerate volatility, stepping in only to smoothen the moves. Now, Forex intervention will have liquidity implications, and therefore the MPC is going to have to weigh that carefully. What else to watch out for in this policy? Well, targeted support for exporters, especially the MSMEs, any sector-specific easing where tariff pressures could bite, possible external benchmark-linked rate extension to NBFCs apart from banks, assurance of ample liquidity, and a clear forward guidance.
Okay, all right, Ritu, thank you very much for that. Watching out for the RBI announcement tomorrow. We'll take a break right now. On the other side, we'll have Manisha join in with the latest from the commodity markets. Welcome back. Well, the equity market is having a quiet morning. Let's figure out what's happening with the commodities. We have Manisha. Actually, Manisha, I think beyond commodities, she's tracking the rains. And Mumbai has been saying, rain, rain, go away. Manisha, is it going away?
No, it's not. But I'll come to Mumbai slightly later. Let me tell you that this is the most important season for agriculture, for farmers as well, because 70% of Indian rain happens between June to September. Now, interestingly, officially the monsoon ends on 30th of September, and I'm assuming that date is going to be changed very soon in coming few years, because this time around as well, we saw the onset of monsoon delayed, and that is the reason the outgoing or the exit of monsoon also is going to be slightly delayed in that sense. But we do follow 1st January to 30th of September. Today is 30th of September. Officially, monsoon ends today. The dates I have is until 29th of September. So all India is 8% in excess, 108% of long period average. And that's exactly the number that IMD had put out in their revised forecast. So that's exactly what we are standing at right now. The only concern has been in the east and northeast. That is where we have seen deficiency of 20%. But apart from that, it has been a good monsoon across other states. Northwest, 27% higher. Central India, 15%. And the southern peninsula also is ending with 10% of excess rains for this season here. Now look at the deficient rains here, and that basically was in Arunachal Pradesh, minus 41%, and then you had Bihar as well with 31% of a decline in overall rains. But the excess states are quite a bit. You have Rajasthan with 60% more rain, Punjab 42%, and then you had 40%, 39 to 40 for Himachal and Marathwada as well. Maharashtra, of course, has been a bit of a concern with various areas in mid-Maharashtra as well. Now, interestingly, when you look at the monsoon this time around, all 4 months were excess monsoon months. So we started with June, and that was 9% above average. You had 5% above average for the months of July and August, and September until now has been 15% more than average. So the mean median of that is 8% or above axis. So 108% is how we get that. Now, when you look at the monsoon in last many years, 94% was in 2023, which is normal or below normal. But apart from that, the last 5 years in that sense have given you above normal monsoon. So it has been great going when it comes to the Indian markets there. Now, above average monsoon in all 4 months is quite a rarity, by the way. 2025 is one such year where you have above normal monsoon every month of this season. And the last time you saw that was in 2007, and then it was in 1975. And then 1961, 1956. So since 1950, if you start looking at data from 1950 onwards, it has been only these years that have seen average, above average monsoon in all of those months. Interestingly, now when you look at Mumbai and monsoons, IMD has moved dates that happened last couple of years itself, that the withdrawal date was shifted from 29th September to 8th of October. But this time around, in this year, IMD says that monsoon withdrawal from Mumbai would happen on 15th of October. Apart from that, when you look at the September rains itself, well, average really is at around 341 mm. For the month of September this year, Mumbai has seen 607. So we're looking at really high, almost double of monsoon that we usually get in Mumbai. Now, what's coming is even more interesting because you have more low-pressure areas being formed all over Bay of Bengal, and that would bring more rains into Mumbai, Konkan, Gujarat, and some parts of Maharashtra. This would be between 4th to 6th October. So is the monsoon withdrawing? No, it's not. It's exactly what I told you. Another very important thing to note out going forward is that La Nina is setting, and it is setting during October to December period. Now, what does it mean for India? Remember, La Nina means different things for different countries. But for India, it means stronger monsoon. So October to December, those winter rains that we talk about are going to be stronger this time around. And the other thing is colder, harsher winters is something that India could be prepared for as well, is what we're looking at now between October to Jan. Actually, there are some reports which suggest that Jan 2026 could be one of the harshest winters that many parts of India perhaps would be looking at.
Well, forewarned. Manisha, thank you very much for that. I really appreciate it. That's a pretty sort of good look, a comprehensive look at the monsoon retreat, but of course, I mean, a wetter October to January, as Manisha pointed out as well. We'll take a quick commercial break here. On the other side is the economy. Lata in conversation with a bunch of experts, Somsekhar Vemuri of CRISIL, Sachin Gupta of Care Edge Ratings, K. Ravichandran of ICRA on credit quality of Indian corporates in the first half that ends today. Stay tuned, coming up.
Welcome to It's the Economy. For those of us who are ruing that the markets are not able to climb up, here's some good news from Indian corporates. The credit quality of Indian companies is excellent. That's the verdict from all the rating agencies for the half year that is ending today, September 30th. Although the credit ratio, that is the number of upgrades divided by the number of downgrades. You know, how many times upgrades to downgrades? This has fallen slightly for CRISIL data. The positive bit is upgrades are maximum in which sector? Infra, power, roads, renewables, data centers, and downgrades are expectedly in export-oriented sectors, especially those exposed to US tariffs, textiles, shrimps, gems and jewelry. MFI's asset quality also still a little shaky, says the CRISIL note. With that, let me welcome my guest, Somashekar Vemuri, the Chief Criteria Officer at CRISIL Ratings, Ravichandran of ICRA, and Sachin Gupta, Chief Rating Officer at CareEdge. Gentlemen, thank you very much indeed for your time. Mr. Vemuri, let me start with you. What's the overall picture? It's looking like your number of upgrades are far more than your number of downgrades, but it is a little less than last year.
Yeah, thank you, Lata, and good morning, everyone. So clearly, with 499 upgrades and about 230 downgrades, our credit ratio is about 2.17 times. It has moderated a little bit from 2.75 that we saw in the first half of previous fiscal. Having said that, it still shows a picture of resilience, especially when you look at the fact that 80% of our rating actions continue to be reaffirmations. And from a sectoral perspective, if you look at it, the domestic-oriented sectors, infrastructure-linked sectors, especially roads, commercial real estate, renewables, construction and engineering, capital goods, and secondary steel. These have accounted almost half of the upgrades that we have seen. And the vulnerability is in the export-oriented sectors, primarily diamond polishers, shrimp exports, and home textiles, on account of the fact that the US tariffs are going to impact these sectors, and these sectors have a fairly higher share of demand coming from the US. Okay. So domestic-oriented economies, there are tailwinds, whereas for the exports, there are a bit of headwinds. Okay.
Well, let me take BFSI, banking finance in particular. Mr. Ravichandran, what does it look like? We've seen a period when banks reported excellent, or rather very low credit costs and excellent asset quality. How does it work out in the first half gone by and in the coming second half?
Yeah, in fact, in our portfolio, financial sector was the only sector where we saw credit ratio less than 1 time, which means we had more downgrades than upgrades. Most of these downgrades happened in the NBFC space, not in the banking space. Oh. The NBFC, microfinance institutions and NBFCs who are exposed to unsecured, MSMEs and unsecured personal loans and so on and so forth. In these 3 categories, we saw elevated asset quality pressures and high credit cost, and certain cases there were significant covenant breaches resulting in acceleration of debt by the lenders and liquidity-related pressures and so on and so forth. And because of that, financial sector saw high downgrades. And in the near term also, we are closely watching this space, and we believe that credit quality may not improve anytime soon in this space. And after that, recently, with the the H1B related issue, even the lenders who are lending to educational purposes, even those category may be marginally impacted. Of course, we'll have to closely watch as to how things unfold. So NBFCs.
One minute, Mr. Ravichandran. Which specific category of NBFCs you said? MFIs, yes. Anything other than MFIs also in trouble?
Yeah, apart from MFI, there are some NBFCs who are lending to MSMEs. Okay. SME-focused, lenders. Especially in certain regions, the SMEs have not been in peak of health, and there have been delay in payments by them, and because of that, asset quality has been, under pressure for some of the NBFCs who are concentrated in the MSME lending. Okay. And we had one default, also investment grade default, in this space because of the elevated, asset quality pressure.
Okay. Let me come to Sachin. What I see from yours is that you all have a large number of non-AAA companies coming to you for rating. And it looks like there is a substantial improvement actually at the sub-investment grade level. Can you take us through? I mean, looks like your B, number of people in B have been upgraded, number of people in A have been upgraded. Can you take us through the, sub-investment quality as well?
Yeah, thanks, Lata. So, in line with what Som and Ravichandran have mentioned, the growth in the credit quality or the improvement in the credit quality is actually across the spectrum. So it's not necessarily only sub-investment or investment. We are seeing improvement in both higher rated categories and sub-investment. In fact, the ratio, if I look at the overall ratio, is still is 2.56x, right, for the overall portfolio that we've done in the first 6 months. For the sub-investment, it's 1.92. So it's slightly lower than that. But yes, within the smaller entities also, there has been, in the segments which are not export focused but more domestic focused, there is an improvement that we're saying that we are seeing. So in hospitals, in small real estate projects or small pharma companies also, we are seeing improvement there, or maybe entities which are supplying to these sectors which are doing well.
Somsekhar, can you tell us what is the worry in the export-oriented sectors? Your press note says that is where 35% of the downgrades came, exporters exposed to the US. Can you give us more nuanced details?
So what we've done is we have looked at a deeper dive of, how are the export-oriented sectors going to be impacted. So totally about $87 billion of merchandise exports were there last year to the US, which accounts for about 20% of our overall merchandise exports. Of this, roughly about $50 billion is currently what is impacted by the tariffs. Remaining 37 is largely unimpacted. And what we have done for the impacted sectors is looked at what is the exposure that these sectors have to the US and how dependent is US on India.
May I stop you for a minute there? That math has been done by every brokerage under the sun, how much exports and how much is to the US. I want to know if they're already showing stress. Jewelry, textiles and shrimps.
Yes. So all these three sectors, we've already seen downgrades in the first half. And they were fairly sizable compared to the portfolio size that we have. Diamond polishers, shrimp exporters, and home textiles. And even from an outlook perspective as well, these sectors continue to remain negative. Because the almost 30 to 50% of their top line comes from the US markets, and it is very difficult, for them to kind of find any alternate sort of destinations very quickly. It will take time for them to rework their market strategies. So they remain vulnerable. And also what has happened is there has been some degree of front loading of exports in the first half in anticipation of the fact that there could be tariffs, etc. There was a lot of front loading which has happened quite a few of these segments. So the real impact will be something which will be more seen and more stark probably in the second half if this 50% kind of tariffs were to continue.
Okay. Ravichandran, which specific SMEs are in trouble? Anything sectoral in what you found?
We found, SMEs who are active in the textile space and engineering. These are the two major clusters where we saw, a slowdown and delays in payment by them to the NBFCs, and even banks also. When we look at the banks portfolio, also we see that SME is one space where we are seeing slightly elevated GNPA levels.
Okay, Sachin, what are you seeing in terms of an outlook? Will the good times continue in the second half, or are they looking troubled?
I think it's certainly not as rosy. I think the future is going to be a little bit more, I would say, cautious we have to be than the past. Essentially, the sectors, so there are two levels that we can analyze this. So one is the directly impacted sectors. So all of us, as you said, textiles, gems and jewelry, shrimps, all these will be impacted. And right now the impact is not yet felt because of the front loading that we discussed. But I think if this 50% were to continue over the next 1 or 2 quarters, I think we will start seeing some serious damage. Even on the rating side, most of the rating actions in these sectors have been more of, watch negative or negative outlook, etc. Because somewhere there is hope that these, some the 50% will be kind of taken off and will come down to 25%. But if this were to continue at 50%, then I think there is serious damage in these sectors. But yes, still I would not say systemic. I mean, roughly 3 to 4% of our portfolio is covered by these companies which are exposed to US. Yeah, so
I got it. I just want last word from you, Somsekhar, since you have the largest number of companies under your coverage. Outlook. Will that good times continue, barring these pockets of exports?
Yeah, so our outlook is that of resilience. Essentially, we continue to expect upgrades to outnumber downgrades, and domestic-oriented, consumption-oriented, infrastructure sector-oriented segments will continue to see buoyancy. Having said that, the pockets of vulnerability continue to remain in the export segments, and in the financial sector, like what others mentioned, the microfinance is still under watch, as well as unsecured lending is something which also bears watching.
Okay. Thank you very much, gentlemen, for that very quick wrap. I'm sorry that we are out of time and we have a lot of rating agencies covering many companies. But the key takeaway that we got from all their data is that sector which was responsible for all the bad loans between 2012 and 2016 or 17, infrastructure is the best performing sector with power absolutely, powering ahead, especially including renewables and data centers, which of course consume a lot of power. So infrastructure, thumbs up. That's the message we get from the rating agencies. Wrap up on Bazaar. Chartbusters coming.